All right, hello everybody. My name is Jason Stapleton, and welcome to Forex Exposed, which I have creatively titled "The Down and Dirty on the FX Market and How You Can Benefit from This Incredibly Lucrative Yet Misunderstood Trading and Investment Alternative." I was actually asked to put this together, and when I was first asked, they said, "Would you do a video about, for people who don't know anything about Forex, talking about the very, very basics about what the Forex market is?" And I thought, help me, baby Jesus. I do not want to do one of those boring videos where we cover, this is what a pip is, and this is what a spread, and the currency market is a wonderful institution that is comprised of multiple banks in different places, and where you can come in a global, international, and I didn't want to do all of that, because that would be boring, and I don't like doing anything that doesn't entertain me. And so what I did was, taking kind of a little different twist, I'm going to explain some things about the currency market. So if you know nothing about the currency market, when you finish this video, you should have a pretty clear understanding of exactly what it is and how it works. And then, of course, if you want to, if you want more information on it, well, then you can go out and seek that information. But for right now, I'm going to take you through the basics of the Forex market, and let's get started. We do have to cover in the beginning a little bit of the boring part. So let me run through that quickly. The foreign exchange market is also called Forex or FX, or the currency market, is a global, worldwide, decentralized financial market for trading currencies. And we'll get back to the decentralized part here in a minute. The currency market is commonly referred to as the spot market, meaning that the financial instruments being exchanged, or the financial instrument being exchanged, is done so immediately. You can contrast this with, for example, say the futures market, where contracts are due deliverable at a future date. Like, I'm going to buy 1,000 bushels of wheat, and I want that I want to buy them on October 15th or something like that. In the currency markets, it doesn't work like that. When you decide I want to buy X number of dollars of currency, that transaction happens immediately or instantly, which is what's called a spot market. To make things really simple, the currency market exists to provide individuals and corporations who deal internationally the ability to purchase and sell goods in different currencies, or to hedge prices and price changes in the future. And what that basically means, guys, in short, is the majority of the people who do business in the currency markets are large banks, are large institutions, and are governments. Those are the major players in this market. It's not speculators like a lot of people think. The big money in the currency markets happens on a global scale by major institutions, major banks, and major governments. So there you go. Now, I know, did I hear decentralized? Well, yes, you did. And I know the question that you're asking yourself is, what do you mean by decentralized? When we talk about a centralized versus a decentralized market, what do I mean by that? Well, let's use an example first of a centralized exchange or a centralized market. And I'm going to use the CME, or the Chicago Mercantile Exchange, as my example. The reason is because I know the CME and I trade a little bit of futures in addition to my currencies, and so this makes it easy for me. So that's why I picked that one. But this could just as easily be, for example, the New York Stock Exchange or the FTSE if you're watching this from across the pond. But at a centralized exchange or a centralized market, what you have is one area. Or one place where everybody decides that they're going to go to make their transactions. And so all the brokers come to the CME, or to the centralized exchange, in order to exchange orders. And everybody kind of puts all their orders into the pot, and then everybody has the ability to buy and sell based on what's in the pot. If you think of it in terms of a bunch of guys getting together and say, hey, we're going to go over our fantasy football league, and everybody's going to come and show up at the Starbucks on 151st and Black Bob at 10 a.m. tomorrow morning, and we're going to do our fantasy football league, and it's all going to happen right there at that Starbucks. That's a centralized location. That's a centralized exchange. Everyone's agreeing to show up at the same spot to conduct their transactions. So you, sitting on the outside, will naturally route your order to your broker, who is at the CME or at the exchange, and will conduct your business for you with all the other brokers who are there. Now, the only transactions that can happen must happen at the CME. They must happen at the exchange. Now, how does this differ from the currency markets? Well, the currency markets have kind of a centralized exchange. They have something called the interbank. And what the interbank market is instead of having one location, what you have are a series of banks that have agreed to kind of coordinate themselves, and they exchange information, and then they basically have, hey, we're going to be part of a network where brokers can come to and trade. And all of the brokers sit along the periphery here of the interbank market. The difference is that the brokers don't all have to go to one specific bank to trade. And the banks don't just pile all of their bid and ask and all of their orders into one centralized area. Each of them can hold those independently. So what happens is the brokers have the ability to trade with one bank or multiple banks in order to find the best bid in the ask spread. Not only that, but the banks can also act as brokers, and do act as brokers, in order to facilitate transactions with their clients and with each other. So you create this kind of this nexus, or this web of bank and broker and place where a lot of different transactions can happen. And this is, in theory, is designed to reduce or to provide the best possible spread, or to provide the best possible order flow, because broker A can do business with with bank A and B, or he can do business with another broker. There is, I will tell you, also periphery brokers beyond the brokers that you see here in, outside the interbank, and they actually will set their own prices. And I'm not going to get into that in this one, but there's actually a whole nother layer to this that a lot of people are not aware of or don't understand very well. And if you want to get a little bit deeper in that, we can in another video. But again, we're just skimming the surface here. But basically, if I have the ability to grab prices from a number of different places and kind of play the best prices off each other, in theory, what I can do is reduce my spreads and reduce what I have to pay getting in and out of the market. And that's what the Forex market allows you to do. Now, if you're already lost, all of this might seem really complicated, and it's not all that important that you understand all the nuances and intricacies of how the Forex market functions. I just want to paint some broad strokes so you know the difference between FX and some of the other financial instruments that you may be more familiar with. And in reality, guys, the FX market works the same way as other markets do. You place your orders with your broker, and they route those orders to the appropriate location to ensure that they get filled. And a lot of times I use the car analogy that just says, look, you don't know how your car works, yet every day you use your car to go to work. You get in and you turn the key and the engine starts. And it works. So you don't have to understand how all the order flow happens in order to trade in the currency markets, but there is a distinct difference there in how orders get routed, and I thought it was important to start off explaining that to you guys. I've labeled this next section Currency Wars, because this is how currencies get traded. They're traded in pairs, and those pairs are pitted against one another in an international struggle for market supremacy. I thought that of myself. But let's use an example. We're going to take the most well-recognized, most highly liquid, and most highly traded currency pair in the spot market, and that is the euro-dollar. Now, the euro in Euro-USD stands for the euro-dollar, or euro currency. So we have the euro currency, and on the other side of that we have, hang on, we'll get to that in a minute. The first currency in our currency pair is referred to as the base currency. And again, it's not terribly important that you understand this. It just helps if some of you guys are very inquisitive, like me, and you want to know this stuff. But the first currency, so the euro is in this particular pair is called the base currency. If we were trading dollar Canada, we would have the dollar, the USD, would be the base currency because it would be USD CAD for USD Canada. The second currency in the pair is referred to as the quoted currency, and in this case it would be the dollar. Now, what that means is the quoted currency is how we describe the value of the currency pair. That is the value of the euro as expressed in or quoted in dollars. If that doesn't make sense, I'm about to clear it up. We're going to break it down here. Let's say the euro USD is trading at 135, okay? Since the USD is the quoted currency, this means that it would cost us $1.35 to purchase 1 euro. So when you see the quoted pair, that's what you need to understand, because if you're trading, say, the euro-yen, you're going to see the price quoted in yen. And it's going to be a little bit different. But again, all I want you to do is I want to give you kind of a frame of reference here. But currencies aren't quoted in cents, they're quoted in pips. What's that, you say? What's a pip? Well, let's cover that. For the Euro USD, price is quoted in 4 decimal places. Normally, the cents behind the dollar are 2 decimal places. As a sidebar, all pairs are quoted in 4 decimals, with the exception of yen pairs, they're quoted in 2 decimals. And so, for our purposes, if the euro dollar was trading at around $1.35, it would be expressed something like 135.21. That last one, or the last digit in that 4-digit pair, is known as a pip. So, for example, 100 pips of movement in the Euro USD is equal to 1 cent change in price. So if I get 100 pip movement, that would take us from 135.21 to 136.30, or 136.21, which is a 100 pip move, or a 1 cent move in the currency markets. All right. What are the pros to trading in Forex? Well, for most investors, it's a highly liquid market. Now, it is not as liquid as some people think it is. They hear, 2 trillion or 3 trillion a day traded, but they're using very, very high leverage, which is another benefit of the Forex market. And so there's really not as much liquidity as people think. You start trying to trade 300 lots at a clip, and you're going to run into some liquidity issues at times. But the important thing is for the average investor or the average trader, you're going to have a lot of liquidity. The market's open 24 hours a day, and a lot of people see that as a negative in the beginning because they think that, well, I've got to be up all the time, or I've got to trade the London session, and that's hogwash. The big benefit of having a 24-hour-a-day market is no gaps. The only time the market closes is on the weekend, and there are even brokers out there that will give you prices over the weekend as well, banks that stay open and will trade over the weekend. So depending on your position, if you're more of a swing trader or a longer-term position style trader, an investment style trader, what it means is that you don't have wild gaps in the market. I'm a swing trader most of the time, or for the majority of my trading, because I do all this education stuff as well. And one of the things that I absolutely hate is when I have a futures position on and I get this enormous gap in the market over the weekend or over the evening period, and it ends up stopping me out, and I lose some distance because my it gapped above my stop. And so by having a 24-hour-a-day market, what that allows you to do is your stops will get triggered at your stops or near your stops. They don't, you don't have these wild gaps in the market that can really catch you off guard. As we said, high leverage, 50 to 1 in the U.S. and 100 to 1 OCONUS, and OCONUS is outside the continental U.S. Most it used to be 100 to 1 for everybody. But now the CFTC's made some new rules and regulations on U.S. brokers, and they can only do 50 to 1, but still, outrageous leverage when compared to, say, the stock market. Variable contract sizes provide traders with smaller account sizes the opportunity to participate. I'll give you an example in the futures market, the E-mini futures. A standard contract, which is as small as you could trade in the futures market, is $12.50. In the currency markets, you can take a standard lot, which is $10 per pip, or basically $10 per point, however you want to refer to it, and we can break that down into mini lots, which is $1, or even micro lots, which is 10 cents per pip. So if you have a small account size of, say, $5,000 or even $1,000 or something like that, you can still engage the market and not constantly be putting yourself in this over-leveraged position. And so if you're new to trading, or if you're wanting to learn how to trade, learn the skill, the currency markets is a good place to get started because you can do so with such a minimal capital investment. And so I really that's probably one of my favorite things about the currency markets, is it gives people a chance to really learn and trade in the markets without having to put, $20, $25, $50, $100,000 up to trade with. More favorable tax structure on profits. Most of the traders that I know you choose a 60-40 tax split. which I'm not going to get into because I am not qualified to be giving any sort of tax advice. But I'm going to tell you that there are some tax advantages to trading in the Forex market as well. What are the cons? No commissions. And I know already you guys are thinking, wait a minute, stop the music. You mean to tell me that I don't pay commissions when I trade Forex and that's a bad thing? And the truth is, in a word, yes. As with most things in life, if it sounds too good to be true, it probably is. And a lot of traders get roped into this concept of, oh, I don't have to pay commissions, so I'm going to save a bunch of money by trading in the currency markets. It's a facade, and I'm going to explain how right now. Some currency brokers don't charge a commission. What they do is make money off the spread. While this is marketed as a benefit to new traders, in reality it can provide unscrupulous brokers the chance to fleece your account without your knowledge. Ooh. Let's look at another example with our good friend the euro dollar. Here is the quoted spread. When you open up your account and you turn it on and you're linked up with your broker and you're ready to trade, you're going to see a bid and an ask spread, and it's going to look something like this: 135.20 by 135.23. And guys, that is a difference of 3 pips. So in this situation, there is a 3 pip spread between the bid and the ask. And basically, you know, that's what I'm going to have to pay that if I want to. If I was to buy and sell at the same time, it would cost me 3 pips to do that. The actual spread at the interbank market will look something like this: 135.20 by 135.21. Now that, ladies and gentlemen, is a 1 pip spread. Now here's the tricky thing, is that you don't know what the price is at the interbank, because all you see is the data feed that your broker gives to you. So while you could, if you had a direct line to the interbank, be getting a 1 pip spread, you're getting a 3 pip spread. And that 2 pip spread, the 2 pip difference there, is what your broker makes and how he makes his living. However, because you don't actually get the real price, you don't get the best possible price, the broker has the ability to slip you without your knowledge. And by being able to slip you 1 pip in and out of the market, a broker has the ability to rake in an additional $4 to $10 per round turn. And guys, that's significant for a broker. For day traders taking 3 to 5 round turns a day, that can be an extra $1,000 a month in commissions, a spread that the trader must pay. And this is completely beyond your ability to even see. It's not like you'd even check for this, because you don't know what the best price coming from the interbank is. Now, in addition, during times of high volatility, a broker can increase his pillage by widening spreads to 5 or even 10 pips. And this type of theft can be very hard to track. All right, so this is a serious downside. However, there's an easy fix for it. In spite of all this shadowy sneakiness, all of this can be avoided by simply choosing the right type of broker. And just so you know, they're ECN brokers. That's the one. I was going to save that for another lesson, but I'll go ahead and give that to you now. It's a cookie. All right? Different ways to play the markets. If all this talk about brokers and high leverage and no commissions and strange order flow is scaring the pants off of you, don't worry. There are several ways to play the currency markets in a more traditional style market. The first one is the futures market. Most of the dollar-based pairs can be traded in the U.S. futures market. At the CME, the euro dollar is called the 6E and trades the same way a standard futures contract would. So if you're looking to, maybe you trade futures already, you trade the S&P, maybe you trade in stocks, or maybe you're an investor, okay? And you're looking for some way to get a non-correlated investment. Well, the currency markets is a great way to do that, and you don't just have to go to the spot market and deal with all of the things that most of the traders I work with, day traders, deal with. You can do it inside of your normal investment and trading style and the normal markets. The other way is ETFs. If you like ETFs, I happen to really like ETFs. I like buying sector stuff in my own investment portfolios. You can simply buy or sell the FXE, which is the Euro Trust ETF. And this is a great way if you're looking for maybe a longer term position, or you're just looking to hedge against another position that you've got out there. The FXE is a great opportunity, and of course in an ETF. So a really nice option for you guys. So let's wrap up. No matter how you slice it, the currency market is a great way to learn the concepts of trading in a low-risk environment or to hedge your portfolio with a non-correlated investment. We've only scratched, and this is the important part I want to get across to you. When I was in the Marine Corps, we had in boot camp, we went and they taught us a bunch of hand-to-hand combat. And the last thing that they said after our week of beating each other up was they said, hey, now don't go out when you get home and try and use this at the bar, because you're going to get whipped, because you only know enough to be dangerous to yourself. And so what I would tell you is after watching this little short 15 or 20 minute video that I put together here, we've only scratched the surface. And what I've done is I've tried to give you enough information to get your creative juices and your inquisitive mind working. And I hope to see you soon, and I wish you the very best in life and in trading. And thank you so much. I hope you enjoyed this presentation, and I'll talk to you soon.